Hi everyone, you're all very welcome to our Wednesday update. Just obviously breaking you through and kind of taking the markets as they kind of come this week. Obviously, what we talked about on Monday with that bearish sentiment, very much kind of tilted toward the downside. It hasn't really let up as the markets are still continuing the current trend. So we've seen some pretty important levels broken kind of yesterday and this morning, and we're going to take everyone through it now. So I suppose before we start looking at the charts, I think it's important to obviously look at the fundamentals and obviously kind of looking at the data. Now, I suppose today and tomorrow are going to be kind of key, very, very important days as we have GDP coming out in the UK. We have GDP coming out in the States tomorrow afternoon. In the US, we're going to have the updated core CPEs and, of course, the GDPs as well. Now, from a fundamental perspective, I think we're obviously looking for the data to be as high as possible. Okay. When we look at GDPs, when we look at jobless claims, you want to see the growth as literally as high as possible, because obviously that means that the economies are doing better in the broader sense. Now, with that, we do also have to look and see that tomorrow and this afternoon we have a number of Fed speakers as well. So we've Fed Chair Powell speaking today, we've Bowman speaking today, we've DeGundus and Panetta speaking tomorrow out of the ECB. So DeGundus and Panetta are highly influential members in the ECB. And for those who don't know, Fed Chair Powell is obviously the chairman of the Federal Reserve in America. So if you're looking at kind of market moving events in terms of fundamentals, then these are going to be guys and individuals that you will want to be keeping a close eye on. And of course, watching to see how does the likes of the GDP figures come out, and of course being able to react to that as well from a fundamental perspective. So we do have a busy couple of days coming up in terms of data, in terms of speakers. So we do obviously have to be aware of that. And of course, given the bearish fundamentals that we're seeing in the UK at the minute, with the Chancellor, Kwarteng, and of course, comments from BOE economic advisor yesterday from Pill, showing that there's going to be a lot of involvement, fundamentally speaking, in the markets over the next few weeks. And as well, like I think in the broader sense, anywhere you look at the last kind of 2-3 weeks, there's been fundamentals, there's been sharp pieces of information and news released into the markets, and we've had to see the markets adapt to that. We have to see the markets kind of take that into consideration and reprice in these assets accordingly. And that's why we're starting to see some very, very sharp moves over very, very short periods of time. And as traders, whether you're short term, whether you're medium term, or even whether you're swing trading within your strategy, you do have to be kind of conscious of that, because that's where I suppose you could have a technical structure, you could be looking at a certain pattern or whatever. But if you get a piece of news and fundamentals contrarian to what you're looking at, it's obviously going to go blow right through. So that's why it's important to obviously couple up or trade on a platform where you're getting instant executions, you're getting really, really good fills. So at least that way, then when the volatility does move, you're getting in and out very, very quickly. And ultimately, that's the most important thing. And I think here at Alpha, that is something that we pride ourselves on as traders. We know how important it is to get those executions, to get those fills as quickly as possible. And I think that's obviously something that really puts us ahead of everyone else in that regard. So I suppose looking at the price action, the other kind of element that we have to take into consideration this week is the massive increases in yields. Okay, the government yields is really kind of blowing up over the last week or two in particular, albeit whether it's the UK, whether it's Germany, whether it's Italy, or whether it's in the US. Now, just the current example that I'm using here is the German 10-year yield. Now, why is the yield so important? Is because it calculates the I suppose the rates of interest that governments have to pay to, I suppose, finance their debt. So the higher the yield levels go, basically is insinuating that the higher the rate of interest that these governments will have to pay to finance their debt. So if these yields continue to rise to, like, let's say 4, 5, 6%, that means that governments are paying an extra 1 or 2 or 3% on top of what they're already paying to finance that debt. So that means that the fiscal side really becomes questionable then, because it's costing governments way, way, way more to finance their loans, their outstanding debt to those in which they are borrowing from. And that is a very, very dangerous game. Now, of course, you only have to look at the yields in the UK to see what's actually happening, where we're seeing doubling in yield prices in 6 weeks or less. So I suppose that shows how volatile these markets are at the minute. And this is something to keep an eye on, because if this continues to rise and elevate, it generally puts a pressure on the broader economies and the broader global economies until such a time when the needle will pop the bubble, and then everything will come falling down like a house of cards. So we also have to be kind of very, very conscious of that as well, because the likes of the higher yield prices will affect all of the other asset classes. It'll affect the sentiment within markets, why the movement to risk aversion, hence the reason why we're seeing that stronger dollar. We're seeing obviously weaker currencies. You only have to look at the Aussie, the Kiwi, the Canadian dollar in recent weeks, even the likes of the euro and the pound as well. All of these currencies are all selling off against the risk aversion. So that's why you're seeing the Swiss do comparatively well. That's why you're seeing the US dollar reign supreme through the course of the year. And on a side note, that's also why you're seeing all of these stock markets break down month after month. Okay. So when we look at kind of bringing that kind of discussion or that point of interest back into the broader markets, we're seeing this dollar continue to churn higher. Okay, over the last number of weeks or so, we've seen that rapid elevation, particularly if you go to a 4-hour chart. It's only last week since we took out 110, 111. Now all of a sudden we're up here at 114. And that has to be repriced into these assets like your euro dollar, like your cable. And that's why we're seeing these trends continue to play out through the course of the year as the dollar kind of continues to remain strong. Now, from a cyclical price action perspective, obviously last week off the back of the FOMC, we had that volatility, the sharp up and downs. Price action, however, did maintain this kind of 110.50 bottom. So that is the nearest bottom as we speak at the minute. However, since then, the markets have been continued to grind up very, very sharp moves to the upside elevations. And at this moment in time, 114 is where the dollar currently stands. My expectation was, if for those who are maybe longer members in the community will know that from the beginning of the year and from, I suppose, March, April, I have been looking at 116s. I have been looking at 120s. The reason why that is the case is because the markets are undoing the cycle of weaker dollar play over the last 20 years. Now, if you look at the price action in 2001 and 2002, we had a dollar index between 116 and 120. That's where the price action broadly traded during that period as the euro came into existence. Now, as we see all the fiscal issues, the financing issues regarding government debt, the energy issues, particularly with this ongoing crisis with Russia and Ukraine, the markets are having to price that in. And the only way to see that is obviously elevation in risk-free assets or safety assets like that of the dollar. And that is exactly why we're seeing this dollar here continue to reign supreme, as we talked about, month after month after month. We've had now 4 consecutive green months, and we've only had 1 down month pretty much on the year. So the only down month we've seen was actually in May, which was a short-term pullback. And since then, every other month in the year has actually been largely positive, which again is testament to the sentiment within these markets. So from my perspective, like as a trader myself, I'm not really looking at anything less than that until we get a change in fiscal policy and change in the fundamentals. There's no real reason to see how this trend is going to change. And I think these levels, like so, become very, very interesting over the next kind of 6, 7, 8 weeks to see how does the markets react. Okay, so do we see price action getting to this 116 to 120? I would pretty much bet that it will happen. But in terms of the broader, I suppose, metrics within these markets and economics, it does align with that view that the price action will probably get to this region. So that's kind of what I'm looking at myself. Now, again, when you look at the short-term perspective as short-term traders, we can just see that kind of gradual grind higher. So we've obviously seen a short-term high here being formed. We have seen obviously markets break through yesterday, and we did get a little bit of a pullback, creating a short-term retracement, and now markets are trying to break through. So realistically now 115 becomes the next psychological level on the dollar index, which again reaffirms euro dollar weakness, reaffirms cable weakness as well, and we have to be kind of recognizing of that element. Now, since last week, as I said on Monday, we've completely cleared through 99. The markets has continued to grind lower. Yesterday, on Monday, we did find new lows at just underneath and just above 96, which did create a short-term bottom for the week. But as you see, every kind of short-term bottom leads to a gradual retrace, leads to a liquidity area or liquidity fill on the price action before we continue the existing trend. Like even here in euro dollar, short-term bottoms coming in at 96 is very, very clear, very, very ominous. We get that little bit of flag back into this liquidity area where we opened on the week. Markets rejected. We've rejected multiple times. And of course, the fundamentals is leaning to the downside again. And that's exactly what we saw. We saw bearish order flow. We see market conditions continue to descend to the downside, and as a result markets have to factor that into consideration, and that is now why we're trading at new lows for the week. So it really becomes a case of, like with the potential for the DXY to go to 116 or 120, will that mean that the euro dollar goes to the low 90s? Well, the initial offsetting area that I looked at, 96, 97, has now been filled. And for me, the next area really is the low 90s. So between kind of 90, 91, I suppose 90 would be kind of the key area. But 91, 92 does look like an offsetting region, particularly if you go out to the monthly charts again. Going across to the full screen, we do have liquidity areas again. So we're kind of seeing the inverse of what we're seeing on the DXY. So it's worth, I suppose, keeping an eye on that, these levels down here, to see if there's anything mitigated or, I suppose, tested. And at this point in time, price action and trend is very, very clear at the minute. And of course, with the euro dollar sell-offs, we're also seeing the cable sell-off. So we saw that on Monday. We had a 4% decline. The sell-off on Monday, this initial sell-off on the weekly open on Monday, was the largest decline in the cable since 1770s. So you can imagine a 250-year record has been broken this week, and this is obviously a piece of history. So the fact that we're alive, the fact that we're aware of this, is obviously something else. And of course, we did that. After that, we did get a little bit of a relief rally. We did get a recovery. Price action did take liquidity between kind of 108 and 109. And since then, the markets have kind of drifted lower. And they haven't drifted as lower in comparison to that of the euro or some of the other FX pairs, probably because of the sell-off that we saw through last week. Okay, it's very, very unusual that a price action structure, a chart, or any sort of asset class drops kind of 600-700 points, unless it's kind of stocks or crypto related. And I suppose that's obviously something else we're seeing. That I suppose even early last week we were sitting comfortably at kind of 112s, 113s, and then all of a sudden by Monday of this week we're sitting at 104. So that was a 1,000-point move. So it's naturally enough that, I suppose, from a pound perspective, they have to reprice this in very quickly. We have to wait to see what's the response by the Bank of England, what's the response by the Chancellor Kwarteng, to see how are the markets going to react to that. And of course, then as a result, these larger institutions then have to try and price that in as a result as well. So we just have to be kind of aware of that. At this moment in time, 107s is kind of where the cable is currently trading at. Would it be totally surprising that we have a runoff and we get another run at these lows? Not really. I think with the way the dollar is currently running at the minute, it would not be surprising to see 103, 104 being revisited, and maybe even a potential run of parity. Okay, so that's obviously something else to keep an eye on that. Now, when we move across to yen, very, very quickly, I suppose yen is an interesting one, because we're not seeing the dollar kind of strength reign supreme, because we know last week the Bank of Japan said about how it's looking to protect that 144, 145 level, and we've actually seen it hold up very nicely into the start of this week. Now, previously, the first couple of weeks of the month, we had this consolidation, which I've highlighted. We had liquidity sweeping lows and highs, both here and of course down here as well from the pre-existing range. We can see that as well very, very quickly. So that is obviously fundamentals, market institutions, market makers, banks, etc., getting involved in the act, the likes of the algos. And this was hammered last week very, very quickly. So this is what I mean by earlier on when I said very, very sharp movements in price action over very, very short periods of time. Within, I suppose, 4 or 5 hours, dollar yen went from 145 back to 140. So you're talking a 500-point move. That is the volatility that we're currently seeing in these markets. And that was nearly a 4% move at around about 3.5 to 3.8%. Since then, we haven't seen much or haven't heard much from the BOJ. And of course, with that gradual grind higher in the dollar, it's meant that we've come back up to revisit this 144, 145 level. And this is the area that I'm looking at very, very closely this week, because we know the fundamentals behind the BOJ. We know that they have a cash reserve of around about 1.25 trillion that they're looking to execute to protect this yen against its currently weakness. And we also have to factor that in, because when the yen or when the BOJ get involved, the yen will move lower quickly. So we'll just have to wait and see when, I suppose, is the time or date that the yen will get involved. And that is something I'll be looking at myself very, very closely. And the next, obviously, element that we're going to look at now is the gold prices. So gold has obviously continued to melt off during the week. And as I mentioned last week, I mentioned it on Monday in passing, generally speaking, the treasury yields, okay, and the gold prices are negatively correlated. So when the yields rise, the gold prices tend to fall. And of course, with the stronger dollar backing that up, all we've seen this week is the gold prices just continue to melt off gradually. Okay, we're seeing that gradual grind higher. The order flow is still playing out. Lower lows, lower highs is still playing out. And at this moment in time, we've taken out this area around 1685 to 1670. And of course, since then, the markets has just continued to grind lower. And I suppose now this then brings in a move that, are we going to see a gradual decline, a gradual assimilation to the downside, at which point then really we then have to look at the broader mechanics within the gold charts. And of course, that then brings in price action structure. And when we look at price action structure, we've got a level down here at 1450s. We've got an order block area here on the weekly at around about 1530. So this is probably the area that's going to get filled over the next few weeks. I'm not sure when. I'm not sure, I suppose, the order that will happen, because I'm sure it'll probably create a few short-term recoveries since that does get met. But when you look at the price action over the last 6 weeks, the gold prices has just been an utter free fall. And again, that's due to the fact that we've had a much stronger dollar on one hand, and on the other side as well, those yields, treasury yields, are continuing to churn higher, which has really affected the gold prices. So at this moment in time, we seem to be selling every kind of short-term rally or short-term recovery in the gold prices and in the commodity prices as well. So this is very, very atypical of another recessionary indicator. When you see the oil prices coming off, when you see the commodity prices coming off, that is a reduction in demand. When you get that shock of reduction in demand, that is a very, very strong recessionary indicator. I know a lot of governments won't admit it, but I think the fact of the matter that we are now well and truly in recession is a fair statement to make. And then, of course, as we finish off, we now look at the indices. So broadly speaking, this is where things get really, really interesting, because I suppose from a higher time frame perspective, we've taken out the June lows pretty much across the board on the S&Ps, on the Dow Jones, DAX, FTSE. We have now taken out lows, and price action has continued to assimilate to the downside. From a higher time frame perspective, markets have broken through the June lows on the S&Ps. We've taken out this order flow here that is witnessed right through the COVID recovery, and at this moment in time, markets are just continuing to grind lower back to this area here, which was the pre-COVID highs before we had that massive shockwave of selling in the markets. So we sold off from around about 3.3 to 3.4, all the way back to 2.2 before we had that recovery up to the all-time highs of 4,800. But since then, markets are continually churning lower. So we've got the first wave, we've got the second wave, we've got a pullback. We're now looking at wave 3. And from my perspective, this is where this area of interest between 3,250 and 3.4 comes into play. And this is something that I have actually been watching proactively pretty much since about February, March, April time, to see would we actually get back to the pre-COVID highs. And of course, at S&Ps, we're actually getting there gradually, albeit slowly, steadily, but we are getting there very, very gradually. So if you're a seller in the market, then of course you're rubbing your hands together with delight, because you can see this as a very, very real objective. Now, I suppose, but anything, it becomes a case of, well, if you're not in an active position, you're trying to get in on the nearest kind of pullback, the nearest kind of short-term rally as such. And I suppose that'll be kind of the aspect to kind of look at between now and I suppose the early parts of October, and maybe into the end of October, is to see, can the price action get there over the next month. But I would be relatively confident that it'll get there in time. Whether or not it'll get there in the next couple of weeks or not is another story. But if current market trends are to continue, then this would be a reasonable expectation. I suppose lastly, then with some of the other indices, then we're seeing the Nasdaq break down. So the Nasdaq is taking down new lows. It's broken out through the June lows. We're just effectively taking out the bottom of the wicks, but now we're approaching the 11,000. So we've broken through 11.5, and the 11.2 area, which was the June lows in the markets, is now looking to be effectively taken out as we see the price action continually churning lower. And now, as a result, the markets is grinding lower, broadly speaking. So that then brings in the higher time frame viewpoint, which we do have an area of interest, which I suppose I'm watching kind of closely between, I suppose, 10,850 and into 11,000, on which was kind of set up from the end of 2020. So this is where we had the really aggressive move in the Nasdaq, really aggressive assimilation to the upside, and now we're seeing that gradual decline. So we've obviously got the first wave, we've got the second wave, we've got the pullback, and we're creating the third wave. So it wouldn't be inconceivable to see the Nasdaq get back to the pre-COVID highs now, albeit we've a little bit more to come in comparison to the S&Ps, but that's because the Nasdaq performance outweighed that of the S&P or the Dow Jones during that COVID rally. It performed a lot better. And as a result, we're getting that unwind. So there's still a little bit to come. I do believe it'll probably get to kind of 9,500, 10,000 gradually. But I suppose from a short-term perspective, let's break through this, I suppose, area of price action from the Q4 of 2020, which is around about this 10,850 to 11,000. And that's, I suppose, something to be kind of watchful over the next couple of days to see how does the markets react at these lows. I suppose if you were looking at broader retracements from these current markets, if you go from market low to market high, you can see that we're getting close to that 61.8. So 61.8 is coming in at 10.50. The discount zone is somewhere between 8.8 and I suppose 9.6, which is obviously something to kind of keep an eye on as well. So you can see how these levels are, I suppose, becoming of interest over the next, I suppose, 6-9 weeks. And of course, we do also have to factor into consideration as well that we do have the midterm elections in November. So when we do have the midterm elections in November, statistically speaking, on average, you tend to get somewhere between kind of an 8 to 10% rally of after the kind of the after the close of the elections in the following kind of 6 to 12 months. So that would be ideal that we see sell off into the midterm elections. We see the third wave of price action continue. We see the cyclical nature of these retracements play out. And then, of course, it's from a longer term perspective, buying in at the discounted prices. And then, of course, seeing is there a rally in these markets. So that's obviously something that's supposed to keep an eye on from a market participation perspective. And of course, being in cash for 9 months necessarily isn't a bad thing, because you're protecting yourself against what has been a very, very bearish year in the broader senses, I suppose. And you only have to look at where we were at the start of the year. Nasdaq is now down a whopping 32.5%. So 32.5% off of any portfolio or trading account is a massive thing as well. Now, again, last with that, I suppose, is Dow Jones in the US. And I suppose the only difference in comparison to the Dow Jones in the US is the fact that on the higher time frames, we have now taken out the pre-COVID highs. So this is obviously something I was looking at with interest this week. We've taken out the June bottoms comfortably last week. We did obviously have an initial bounce off this 29.5, but the sentiment this week has continued. The markets have broken lower. So you can see how this pre-COVID high is a really good barometer in terms of judging potential price action structure from, I suppose, not just a short-term perspective, but also a medium and a longer-term perspective as well. And that's exactly where we are in these markets at this moment in time. And again, if you apply logic of retracement into lows, of course, a run up into new highs, we could very easily see 23 to 25,000 coming in, particularly when these markets are selling off approximately 30,800 to 29,700. So that was 1,100 point, 1,200 point sell off last week. And from where we are at this moment in time, 29.5, 29.6 into 28.9 is a 600 point sell off this week. So in the last 7 trading days, we are down approximately 2,500 points on the Dow Jones. So we have to put these percentages into, I suppose, into perspective as well. And we've broken through the COVID highs, or pre-COVID highs as well. So from there, shorter term perspective, we did have short-term consolidation on the Dow Jones this week. We did come back up to retest it last night. The order flow is still very much continuing to the downside. From my perspective, again, repeating this element, if you're not short, you're proactively looking for those pullbacks. You're proactively looking for those retracements and looking to, I suppose, carry the trend. So it's important to be able to recognize the trend within the price action, because you don't want to be taking the other side of the trend, because obviously momentum, sentiment, fundamentals are just going to continue churning, and obviously you're going to get taken out as a result. And then, of course, lastly, in the FTSE UK, we're seeing that break of 7,000 we talked about last week, which is obviously important. And now we're coming back to this 6,800 level. And I suppose the only thing that I would say with this FTSE chart is that this is the asset that never made to new all-time highs, even though every other indice did in the last 2 years. Which is, I suppose, recognizing of the fact that the fundamentals within the UK, with the political uncertainty, with Brexit, and everything else that has gone along with that over the last, I suppose, 5-6 years, is very, I suppose, real. And I suppose we do obviously have to be aware of that. But 6,800, I think, is now the new area of interest to be kind of aware of over the next week or so, to see, does this area hold up? Because if it doesn't, we're going to get that slide. We're going to get that unwind. And it realistically looks at then the price action is going to try undo all of this bullish price action that we've seen over the last, I suppose, 16 to 19 months. And then it becomes a case of, well, this area of interest really becomes interesting to me, because this is kind of the last swing low. We've obviously had short-term lows, order block area, price actions churned higher into consolidation, and we're now seeing that bearish wave of price action coming through. So from my perspective, if we're breaking through 6.8, this trend continues to churn lower. Realistically, now the next medium to longer term price action point becomes 5,850 into 6,000, and that's what I'll be looking at myself. And then, of course, lastly, before we finish up today, is the DAX in Germany. And of course, with the DAX in Germany, the European issues have been a complete and utter mess at the moment, both from an ECB perspective in terms of its lagging fundamental policy and raising rates, the broader debt issues, the political issues, particularly in some of the Eastern European states, and of course, then the Italian debt, the debt in some of these so-called broader, more important, influential nations in Europe as well, is a massive problem. And I suppose when you look at the DAX and the top 40 stocks in Germany, you can see how grim it's looking as we speak. We've had the highs at the start of the year. We've had the gradual sell-off. We've had cyclical correlations within markets, of course, over the last, I suppose, 6-7 months or so. Obviously, the energy crisis, the war with Russia, Ukraine, all of these issues have compiled to a weaker DAX. And of course, last week we broke through 12.5. We did say last week, break at 12.5, have a look at this 11.5 level. And at this moment in time, I actually wouldn't be surprised to see this level give away. 11.5 would bring in a much deeper move lower. And of course, that even really brings the bell in for a knockout really to the DAX. Now, when you look at DAX performance since, I suppose, the early parts of the year, looking at even the DAX highs on an intraday level, again, 28%, absolutely struggling at this moment in time. When you look at cyclical corrections within these markets, of course, broader perspective, you can see we've taken through the 50 way. So we're actually through the halfway stage, and we're getting into some of these levels. So 61.8, 11,000, 71 to 78 is the discount zone, 9,750, 10,4. This really becomes the opportune discount level. And I suppose that's what a lot of institutional assets managers are probably looking at in I suppose the longer run perspective. All right, so that's the higher time frames, guys. So I suppose shorter time frames, you can still see the order flow continue to break down. Again, like the other ones, waiting for that pullback, waiting for those short-term retracements, and looking for the downside continuation. Thank you, everyone. Have a great day.